Hey everybody, Matthew Cole with West Shore Mortgage in Sacramento. Today we're going to discuss an impound account for taxes and insurance, and what the hell is that thing? So your impound account, which is going to be an account that's set up separately to pay your taxes and insurance on your home that you just bought or just refinanced. So if you're a buyer and you just purchased a home, you're going to go through your closing statement and you're going to see a breakdown of your payment. There's going to be your principal and interest, there's going to be your taxes, your insurance, maybe mortgage insurance. Let's just talk about taxes and insurance. Every payment you make, your taxes and your insurance are going to be included in that bulk payment if you request it to be. It doesn't always have to be, but if you're putting less than 10% down on a conventional loan, it has to be in there. So when you have your taxes and your insurance, you're going to bulk that part together and it's going to be included with your principal and interest. So initially what will happen is your lender will collect an additional amount up front to pad the account. What this is going to do is that when you make your payment for your mortgage every month, your mortgage payment is the only thing that's paid in arrears, which means backwards. February pays January, March pays February. So when you do your impound account for your taxes and insurance, your taxes and your insurance part get paid going forward. So when you close your loan in January 2021, let's say, to January 2022, your taxes are actually due twice a year, once in the middle and once in the beginning, so that when they make that payment twice a year for you, you don't have to come out of pocket that money. So typically what's going to happen is the lender will create what's called an impound account so that when you make your monthly payment, the lender will take small portions out for your taxes and your insurance so that when your taxes are due twice a year, they'll pay each installment separately for you, and then when your homeowner's insurance is due, they'll go ahead and pay that for the year again. You don't always have to create an impound account for your taxes and insurance. You could do it yourself. You could put the money in your checking or savings account or just create a separate savings account each month, and you could pay that impound account yourself so that when they're due, you got the money set aside and then you can make the payments for you. The thing about the taxes and the insurance is that even though the lender still pays them on the impound account, you're still going to receive your bill when the insurance is due, and you're still going to receive a bill when your taxes are due. Just take those and file them away because you're going to need them for future just to kind of confirm what they are and just to keep for your records. But the lender will always pay them. And you can always see what's paid and what's collected on your mortgage statement each month. There will be a line item that's set up that says, escrow account balance or something in that nature, to where it shows the accumulated amount that you've paid into your balance. And then it'll also show down below typically anything that's been paid out to your insurance or your taxes. The hardest part about an impound account is that when you're purchasing a home, it's a big chunk of money that they want sometimes up front, depending upon the time of the year you're closing. Not every time of the year they collect the same amount than they would another, because it's all based on the date that you close your escrow and when your first payment is due. So typically the number they collect is going to be anywhere between 2 and 8 to 10 months of taxes and even sometimes up to 14 or 15 months of insurance. So when you're buying a house, that's a big chunk of your closing costs. So you always want to kind of be mindful of that amount. And if you can take it upon yourself to set up your own impound account, it will help you with less fun money out of pocket up front when you're buying. A lender is never able to take more than what's necessary to be in that impound account. So if they collect too much, they'll always get a refund back, or they'll just go ahead and pay whatever that's available. Say for example, the supplemental tax bill that we talked about previously. If there's extra money in there, you can send them the supplemental and they'll pay that for you. So if you got any questions about your impound account and how to set one up, or even how to best manage it yourself, give me a call. I'd love to sit down and go through it with you to better help you understand what it's about.